I'm curious what pre-approval is, so I'm gonna ask my son. Here we go. So, son, what's a pre-approval?
I do not know.
What are you doing there? Are you reading a book?
Yeah.
Oh.
I'm done.
So you're... Oh, okay. I guess it's to me then to explain what a pre-approval is today. Hello everyone, welcome back for another episode of the Mortgage Guy 101. Today I want to walk you through a super important step if you're thinking about buying a home, the mortgage pre-approval process. First off, let's clear up the differences between pre-qualification and pre-approval because people mix these up all the time. Pre-qualification, that's quick and easy. You give the lender some basic information about your income and debts, maybe online, just a few minutes may take. They rarely do this, but they might do a soft credit check that doesn't really hurt your credit score at all. However, in the end, you get a rough ballpark of what you might be able to borrow, but it's not very official in that the lender can recant on their offer, which I have seen personally. This happened multiple times. Due to this, if a pre-qualification is provided with your offer, sellers don't usually take it seriously. The pre-approval, that's the real deal. It's more serious, it's more detailed, and it gives you and your seller a much stronger signal that you're a serious buyer. Here's how the pre-approval process actually works, step by step in 2026. Things are pretty similar to recent years, but always double check current rates and rules. So the first step, you want to get your own finances in order first, before you even talk to a lender. Pull your free credit report. I would recommend going right to the main credit bureaus and getting a free copy from each, Experian, TransUnion, and Equifax. Since these three bureaus are the main source of information, it's most wise to go directly to them. They must provide you a free credit report each year, so take full advantage of that. Check your score, figure out pretty much what your debt to income ratio is. You want to aim for around a 43% in that debt to income ratio area. The higher your credit score, especially a 740 or above, the better your rates. And you want to work towards fixing any red flags if you can as well. So if you see those, you want to deal with those right away too. Now, you're not sure how to figure out your debt to income ratio? If you're not sure of that, a mortgage broker like myself could quickly do it for you. However, our method is a little more detailed. Good for you though. There's a quick and simple method that you could follow that would place you in the ballpark area of what your mortgage broker would likely come up with. In short, you want to take all of your recurring monthly debts and divide them by your total monthly income. The ratio will help help your lender to decide which loan is best for you. If you get below 43%, you'll get the most favorable loan options. If you find yourself higher, then look into paying off a few debts to help in lowering it. However, keep in mind though, I've seen some as high as up to 57% and still be able to get a loan. So don't feel like you're out of the ballpark yet, okay? You want to reach on out to your mortgage broker like myself. They can kind of help you navigate that tunnel there too. Now, you will most importantly want to aim for particular debts that are also seen as a derogatory mark on your credit report. This way you're hitting two birds with one stone. Now, the second step in this process, you want to shop around. Pick a few lenders. Compare a few banks, credit unions, online lenders, mortgage brokers. Look at the rates, the fees, the loan types, like conventional, FHA, VA, if you qualify. You will start to find some lenders are amazing when offering certain types of loans, but are not when offering others. When I work with my own clients, I personally love to make sure that I'm providing them the best rates. So I'm completely open to them shopping around and them coming back to me so that I can beat the rates, and then typically I do. Now, the third step in the process, you'll want to submit the pre-approval application. You fill out the form, usually it's online. You'll share your income, your job history, your debts, your assets, how much down payment you plan, and the home price range you're eyeing pretty much right now at the current moment in time. Now, the next step, you want to send over all of your documents. They verify everything. This is what makes a pre-approval more serious and more accepted by a seller than a pre-qual. In this step, expect to provide your ID and social security number, recent pay stubs in the last 30 days or so, W-2s and tax returns, usually the last 2 years, bank statements, 2 to 3 months usually worth, to show the savings and down payment funds, statements for investments or retirement. If you're using those, and details on any gifts or other income or debts like student loans or car payments. If you're self-employed, you'll most likely have to provide extra business docs too. The next step, the lender reviews it all. They pull your credit, yes, a hard inquiry, so your score might dip a tiny bit temporarily. They check income, calculate your debt to income, assess risk, then they decide your max loan amount based on today's guidelines. Now, in the next step here, if it looks good, you're going to get the pre-approval letter. They send you a letter that usually goes for 60 to 90 days, sometimes longer. It says something like, we're conditionally willing to lend you up to, we'll say, $450,000 with an estimated rate. It's not 100% final. Things can change, but it's powerful when you make offers. Typically, the only thing that would change the pre-approval would be a loss of income, new large purchase that you've done, or a credit default. 9 times out of 10, it would likely be due to something the borrower has done or has occurred to the borrower on their end, and that had changed their current standing. The whole thing typically takes about 1 to 7 days, maybe even same day if your docs are already in order. Why bother? In today's market, especially competitive ones, sellers and agents want that pre-approval letter. It shows you're serious, you can afford the home, and you won't fall through. Plus, you shop confidently without wasting time on houses that are way out of your budget. So if you're ready, start by grabbing those pay stubs, tax returns, check your credit, then get in touch with someone like myself. You've got this. If you have any questions or comments, drop them below. I'm happy to help. And if you like this content and feel that I could be helpful to others, then smash a like, subscribe, and share it with others in your community. Thanks again for watching.